freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I am here, as always, with Adam Penn. Hi, Adam.
Hi, Dustin.
How are you today?
Doing good. Sunny day out in California. It's been crisp in the morning. Like it was 44 degrees this morning, but it's nice in the afternoons.
I do have a very important question for you.
And?
Have you gotten scammed since the last time we talked?
Not since the last time we talked.
Okay, well, that's good. That's good.
Yeah, I did fall victim to a Facebook scam. I was, which is surprising, having a software engineering degree and being fairly adept at things. I was multitasking, trying to buy concert tickets from someone just on Facebook Messenger, and I was like, "Yeah, it's like $140." So it's not like I got majorly scammed, but like it was only the money, and I'll send it. And their profile looked real enough, and it wasn't real. But within an hour of that happening, I got 4 of their Facebook accounts shut down and 2 of their Zelle numbers closed through Chase Fraud Department. So they probably weren't expecting that when they scammed me.
Probably not. This is the advantage to having direct access to someone at Chase that can immediately jump on some of this stuff, even for a relatively small dollar amount.
Yeah, that was not me sitting on hold with Chase for a few hours. It was when I finally realized. I just texted our banker, and he's like, "Okay, I've reported it to the Chase Fraud Department. No Zelles from Chase can go to that number anymore. Other people could still Zelle. It was a Wells Fargo account, but he's like, it only populates through decently quick."
Crazy. Also a good lesson. I mean, you and I were talking about this earlier. Like, we're both pretty aware and able to catch these scams. And if you're not paying attention, like, it can get you, right? Like you really need to be careful, especially in those types of transactions. Because I think you said the account had dummied up some photos and had backdated them and had done some other things.
Well, and it had done enough. Like, it was a girl who had a newborn. Her husband like looked like he belonged in this area. Had like a Bible verse in the first paragraph. Said married. Like, they had done some work on this profile.
Sophisticated. I mean, you got people sitting on the other side of the world that this is what they're doing all day long. So
it's their job.
It's a good reminder, but nice job getting them shut down. That was good. They scammed the wrong person.
Stupid. We'll see. I bet Chase ends up giving me the $140 back, even if they don't get it. That's been my experience, is that they'll just credit the account. But
yeah.
Still stupid. Again. I don't have my concert ticket. That's all I wanted.
Oh man. Well, hopefully it'll all work out and be able to find. Just be mindful of searching for anyone that's saying they've got tickets to something that's sold out, right?
And we're trying to go to a dinner tonight that needs a ticket, and it's sold out. And I was texting my buddy. He's like, "They're available on Facebook." And I had told him about this at lunch, and I was like, "Yeah, very funny."
Yeah. There's lots of people that have them for sale. Well, speaking of scams, I think it's probably a halfway decent transition into what I want to talk about today.
Yeah, I don't know what we're talking about today. What are we talking about today?
I was going to say, I don't think I've given you much heads up for this, but there's a couple Wall Street Journal articles. I guess one's not really a scam, but the other's talking about the stock market and pensions, and so I don't know. There's maybe some tenuous connection there, but article number 1, I came across this. This is, I don't know, we're recording this in mid-April, so this article's a little bit old, but it's still timely. If you're not watching on YouTube, you definitely should be. But the title of the article here in Wall Street Journal is, "Think Tech has taken over your portfolio? You should see what's in your pension." And the subtitle is, "Retirement managers and insurers are racing to figure out how AI might help or hammer software investments held in private funds." And so this really stuck out to me. The first line here says, "Pensions foray into private markets left them with a big slice of America's tech economy. Now they're attempting to assess what artificial intelligence might mean for those investments." And I mean, to kind of to not bury the lead or give the bottom line up front here, is you've got a lot of folks, especially if you're lucky enough to be older and work somewhere and you had a actual proper pension. I think a lot of folks look at that as guaranteed money, right? Like, the pension's not going away. It's going to pay out, right? But the reality is, a pension is nothing. It's funded by investment returns. And Adam, I guess this is especially true out there in California. You got a lot of public, what is it? CalPERS
Yeah.
is the big one.
Teachers and all that. Who's that company that used to give people checks on their doors and they ran out of money?
Publishers Clearinghouse.
Yeah.
I
It's like
don't
the
think
same
that's
thing,
the
right? They
same
thought this
thing.
money was guaranteed for life.
Okay, well, it's like winning the lottery. But I think there's a lot of people that don't realize that the pension is actually funded by investment returns, and on the whole, those tend to be, more safe things, right? Pensions aren't known for being at the very bleeding edge of risk for investment returns. But at the same time, as this article kind of pointed out, everybody went somewhat in search of yield, right? They were trying to get higher returns in order to pay those. And that kind of naturally led to riskier and riskier places. And I say risky, again, we're not talking about CalPERS is invested in Bitcoin, which who knows, they might be, but it's not that level of risk. But the main point here is, if you think that you don't have exposure to tech because you don't own any tech stocks, and yet you have a pension or you have other things that are funded in a similar manner, you actually have more exposure to tech than you would realize. And then now you've got folks that are trying to figure out, again, what does it mean that there's a growing concern, as the line says here. And there's a private credit tie into this as well. We talked previously about Blue Owl, because you've got some pensions and some other, large institutional money like that has invested into the business private credit, particularly in software. And so there's, some concern about some exposure there. But then also, given the fact that tech has kind of crept into these portfolios, there's just this open question of what does that mean, especially in the context of AI. And then if AI and tech and some of the same concerns that are happening over in the business private credit space, what's that going to mean for these more institutional, very risk adverse things that have amped up their exposure to tech in search of yield? So this article is not really kind of making any sort of conclusions, other than the last line here is kind of funny. I have no idea who the winners and losers among the world's largest tech companies will be, but I'm happy to get a solid return on a data center investment. And I think that's kind of been the attitude here, right? You've had these large institutions going in search of yield to be able to continue to fund pensions and other liabilities like that. And it's now led to some exposure that is making some people somewhat nervous. And again, for individual investors, if you think, well, the pension is guaranteed money, it's guaranteed until it's not, right? Like eventually, if the returns aren't there, then you can't manufacture the money out of thin air. So I don't know. I didn't have any really specific takeaways or other.
Oh, I just think the underlying point is just that. So investing is this black box to so many people.
Yep.
And like we've talked about a lot, right? You should probably understand what's in your portfolio, how it works, what you're doing. You don't have to go do all of it, right? But, I think maybe an example of that for me is that we have a bunch of oil wells. I mean, I have a general understanding of how it all works, right? But I'm not an oil well operator. I don't think I could go set up a rig and drill it by myself, at least not as proficiently as they do. But I understand how to evaluate the deal, what's involved in it, what the geology looks like. I'm not a geologist, but I have a little bit of insight, and I think that's what a lot of people are missing, right? They take so much of their income and they just pass it off to this so-called retirement program, but they don't know what's in it. They just know that they're going to be able to retire, right? But they don't actually have a plan for it. And I think that if most people treated the job that they do day to day just in the same way, right? I don't know what's happening. It's just going to happen at some point, right? They'd be fired. So why are they doing that with their own retirements?
Yeah. I mean, this is something I write about fairly often, is that you're exposed to, if you are trusting your retirement and even cash flow for your life, even if you're pre-retirement, but if you're trusting that to somebody else, you're really exposed to more risk than you realize. And I think this is why this stuck out to me, because I think people can kind of conceptualize that when it's like, okay, well, I'm my 401k, we're invested in some stocks. Like, yeah, there's some risk there. It goes up and down. But most people don't look at their pension, if they have one, you don't look at that as risky money, right? And it's more or less viewed as that's going to be guaranteed, it's going to be there. But the reality is it's backed up by investment returns, just like any other portfolio. And if you have some other larger systemic event, and I'm not saying that I think that's going to happen here, but it's still exposed to risk, right? Pensions don't manufacture money out of thin air. I think that's the big thing here. And if you again are relying on this or something else, you've abstracted away some of that control, and then now you have introduced an additional level of risk to your retirement, your life, that maybe you didn't mean to do. So that's why we like to talk often about pulling that back, taking control, being very active in making some of those investment decisions and not just passing it off to the black box of whether it's a pension or the 401k or whatever. Article number 2 is not necessarily related, but it's somewhat timely. I think it's something we've talked about, we've heard talking about, but this was the first time. Again, this is now almost 2 months old from when we're recording this, but this was the first time that I had seen this type of headline in a mainstream financial publication. So again, if you're not watching on YouTube, you're not listening to us only, the headline here in the Wall Street Journal says, "Lenders to commercial real estate owners, pay up now." And this was talking specifically for office, but Adam, I think from the conversations you and I have been having and what we've been seeing, this is happening elsewhere, right? The era of extend and pretend is more or less over. And for anyone that's not familiar with that, there's starting all the way back to when the Fed started raising interest rates in 2022, you've had loans that, especially commercial debt on commercial real estate that was floating rate, obviously shot up and in some instances became unserviceable, and owners were having to come out of pocket to make those. It was kind of a bad situation. And in other normal times, we'll say, the banks would have just gone ahead and foreclosed on the properties. Well, the thing is, there was so many of this, and it was so prevalent that the banks were kind of like, well, we'll work with you. And they weren't really foreclosing on properties, which that's its own side thing, where you had a whole lot of people that were predicting all these blood in the streets. There's going to be, properties for sale everywhere for pennies on the dollar. We're picking them up on the courthouse steps for cheap. None of that panned out because none of the banks wanted to actually admit that these loans were that far underwater. So they extended the loan. It might have been a 3-year loan, a 5-year loan. They would extend maybe 1 year, 2 years, whatever, and pretend like everything was okay and maybe it'll recover. Maybe the Fed will decide to change their mind and lower interest rates. And so that kind of got known as extend and pretend. And the pretending's over is basically what's happening. And I really thought it was interesting. This narrative has been going on, I think, in the circles Adam and I run in for a while. It was really interesting to see it printed here in the Wall Street Journal. And I think that's, there's an old saying that by the time you read about it in the newspaper, in the Wall Street Journal, it's too late. The opportunity's gone by. So that said, I don't think the opportunity's gone by to pick up deals that are coming as a result of this. But at the same time, this is now no longer just someone's opinion. You've got banks that have finally decided we've got to do something with these loans. We got to either sell it, write it off, whatever. And what, at least for multifamily, which is where I've got the most exposure and we talk to other people, they're not truly foreclosing on these notes, right? The banks are working with buyers and sponsor groups, other syndicators that they may have worked with in the past that they know can close, can operate on these deals. And they're basically shopping the deals privately to those people that they know and trust. So again, this is another thing in the folks that were calling for blood in the streets, even though now like the actual selling is happening, right? Like these loans are finally coming due and the banks are essentially foreclosing, but it's not a proper, judicial foreclosure with an auction on the courthouse steps. It's a private sale that's happening to folks that are kind of already in the know. So the crash narrative is just not playing out. And I was never fully convinced. I don't want to turn this into an I told you so episode, but I was never fully convinced that this was how it was going, that it would all just crash and we'd be picking up properties for pennies on the dollar. And that's kind of how it's panning out here.
I mean, we've seen the same thing inside of our private credit fund, right? Some of the sponsors that we've handed money to picked up deals directly from a bank. They were handpicked because they've dealt with this type of distressed asset before. So
Yep.
to your point, I don't think it's just the courthouse steps. And that example I'm talking about is almost 2 years old now.
Yeah. And we've got, Adam and I've got friends that buy multifamily in a couple different markets, and they both are kind of those preferred groups among some lenders, and they have been shopped these deals. And that has even been going on for more than a year now, right? Like this. So this is not sort of behind the scenes or, under the surface kind of selling of these properties. That the property itself, in most instances, is not distressed. It's really the capital stack that's distressed. So there's nothing generally wrong with the properties. But it was, again, floating rate debt. It shot up so much, and the sponsors can't afford to buy rate caps or didn't buy a rate cap, whatever. And so the sales are finally happening, but it's happening quite quietly. And these properties are exchanging hands, and some people are getting some very, very good deals. And to Adam's point, and we've been lucky to get some exposure to that through the credit fund. And you got some folks that are picking up some really, really solid properties at a really great basis, and some things that are going to go well. So all this to say, some of the COVID era remaining loans that were still floating out there, a lot of that's finally starting to flush out of the system, but it's not happening in the way that I think a lot of people thought that it would. I don't know, Adam, any other thoughts? I don't have any specific takeaways from this article.
I tend to agree. I think it's just good to watch this stuff and kind of continue to either validate or correct opinions.
Yeah. Well, we will make sure that if you're interested in fully reading this article, this specific one in the Wall Street Journal was really focused on office buildings and CMB. They got a big chart here for the CMB office delinquency rate, but we'll make sure that links to both of these end up in the release notes, as always, so you can check these out yourself. Always encourage you to go read them and see what's there. We can keep this as a pretty quick episode. I always like going over some stuff that we see in the news like this.
Seems good to me.
All right. Well, everybody, we appreciate you listening. As always, if you enjoyed this, go do all the stuff that lets the computers know that. Give us like and subscribe on YouTube and a 5-star rating on Apple Podcasts and whatever in the world it is you do on Spotify. I have no idea. But go do all that. Again, let them know. Let the algorithms know. We'll get the message out to more people. We would appreciate it. But we do appreciate you being here. Thank you so much. And we'll catch you on the next episode. Just remember, where freedom leads, where wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.